Now, what happens when the interest rates rise in these situations? Which this is different. We didn't have this in 2008, right? We didn't have interest rates rising. We didn't have inflation skyrocketing. This was the largest situation of financial fraud in the country's history. So, what's the effect of interest rates rising, which can cause a recession? And it looks like it is in some industries here, on both the equity and on the debt side. So the capital stack returns during high interest rate environments. So higher interest rate payments reduce the profitability for common equity. They decrease valuations, they increase debt service, they decrease income. And because of that, people will pay less. If the debt costs more, they pay less for the properties, right? So if you're holding an asset and interest rates goes up, it's not a good day for you. What about in the debt? Higher interest rates actually mean payments that are higher to you, returns that are higher for you. All things considered, the same property at the same leverage in a higher interest rate environment is more profitable for the debt people than that same property in the same environment in a low interest rate environment. And dramatically, because their returns go up. Properties, for example, that were on the market for 6 or 7, 8% interest loans just a year or two ago are now 9, 10, 11% interest loans from banks, right? But as we'll talk about later, banks are pencils down. So sometimes those loans, just because of the demand, are 13%. And actually, that's actually what we're lending at right now. So the returns in debt today can actually be somewhat analogous to equity of a couple years ago at the lower risk premium in this particular type of recessionary environment.